In past episodes, we have talked about some of the most important aspects of Social Security benefits, from filing strategies to the different types of benefits you may be eligible for. But today, we're going to tackle what actually could be the most confusing component of Social Security, and that is how Social Security gets taxed, even something called the Social Security tax torpedo. Welcome to another episode of the Simply Retirement Podcast, where we want to educate and empower women to live your retirement on your terms. I'm your host, Eric Blake. If you've been following along with past episodes, you know we spent a lot of time talking about how important Social Security planning is, especially for women who may be going through or have gone through a divorce, have been widowed, or maybe just managing retirement on your own. Social Security isn't just another income stream. It is often the foundation of your retirement security. And even if it's not the foundation, it is often the only source of retirement income that is guaranteed for life and increases every single year with inflation. And how you plan for it and how you manage taxes around it can have a huge impact on the money you actually get to keep. Before we get into everything, I'm going to introduce Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I am very good. So I'll ask you right off the top, have you ever heard of what's called the Social Security tax torpedo?
Not even once.
Not even once. Well, you're going to learn all about it today. How's that?
Oh, I can't wait.
I bet you can't. So here's what we're going to do. What I want to do is break down. I want to talk about how Social Security gets taxed. I'm going to talk about what the tax torpedo is related to Social Security. Also, why it can be dangerous for women who eventually may be filing single later in life. We're going to talk about how withdrawals from your retirement accounts can make it worse or actually make it better. And we're going to talk about, as always, some of these strategies that you can use to minimize things you want to do now to potentially minimize taxes and, of course, make your retirement income last longer. Does that sound good?
Yeah, I like it.
Awesome. Well, so let's start with the most important part of this, and that is how Social Security gets taxed. And there's a lot of people who actually think Social Security is tax-free. Unfortunately, it's not. And this is not a political comment one way or the other, whether you should think it should or shouldn't be. But the fact is, it is not tax-free unless you have very low income. Now, one caveat before we get too far into it, we're going to talk primarily about federal taxes today. There are actually states that do not tax Social Security benefits. But from our perspective, we're going to talk about the federal taxation of Social Security benefits. And whether your benefits are going to get taxed or not depends on something called provisional income.
Okay.
So let's talk about what provisional income is first. This is a special formula that is only used for figuring out how much of your Social Security is going to get taxed. Okay. So the basics of it is a very simple formula. It's your adjusted gross income plus any non-taxable interest. And this is one of those tricky ones that people don't realize. So things like municipal bonds or municipal money markets, you actually have to add the interest from those sources of accounts to your adjusted gross income when you're figuring out the taxation of your Social Security.
Even when it's still you haven't sold it.
It's federally tax-free. The interest that you earn from municipal bonds or your municipal money market accounts, it is federally tax-free, but you have to actually add it back into the formula when determining if your Social Security is going to be taxable or not.
Oh.
Yeah, sounds like fun, right? Who came up with that idea? So you've got adjusted gross income plus non-taxable interest like municipal bond income plus 50% of your Social Security benefits. That is the formula for provisional income. Now, I'm going to give you one hint right here. One of the things you did not hear me mention is Roth IRA distributions. And you're going to find out why as we go through this. But basically, if you think of it like this, your provisional income is basically all your other income, like work, IRA, or 401k distributions and withdrawals, interest, capital gains, plus half of your Social Security. That's the provisional income formula.
Okay.
So then let's kind of give an example. So let's think about, somebody's retired and they have $30,000 of IRA withdrawals. And then maybe they have $5,000, maybe they do have some municipal bonds. They have $5,000 of tax-free, quote unquote, tax-free bond interest.
Right. So it's not really tax-free, right?
It's federally tax-free, but it may actually increase how much of your Social Security gets taxed. So it is definitely tricky.
Yeah. Okay.
So in our example, you got $30,000 of IRA withdrawals, you got $5,000 of tax-free bond interest, and let's say you got $20,000 of Social Security benefits.
Okay.
So $30,000 of IRA withdrawals plus the $5,000, that's $35,000, plus half of your Social Security, that's $10,000. So in that example, your provisional income would be $45,000.
Mm-hmm.
Okay. And this is the only place that number gets used is to determining how much of your Social Security is going to be considered taxable income. Now, there are provisional income thresholds. Okay. And I'm going to give you a little bit of history on those in just a bit. But basically, for somebody who is a single filer, if your provisional income is less than $25,000, no tax on your Social Security benefits.
Okay.
Okay. So tax-free. In that instance, it is federally tax-free if that's the only income source you have. Then we go to $25,000 to $34,000. If you're in that range, up to 50% of your benefit could be taxable. That does not mean that 50% of it's going to be taxable income, up to 50%. So there is a calculation there that has to be done. But somewhere up to 50% will be considered taxable. And again, if you're a single filer, over $34,000 in provisional income, up to 85% of your Social Security benefit is going to be considered taxable income.
Okay.
Okay.
I'm following.
Okay, stay with me here.
I don't like it, but I'm following.
Okay, now let's talk about married filing jointly. And this is going to eventually get us to that point of why for single filers, why these numbers are so critical in helping and creating strategies around this. So a married filing jointly, less than $32,000, your Social Security benefits, not taxable. Between $32,000 and $44,000, up to 50% of your benefit could be considered taxable income. And then over $44,000, up to 85% of your benefit could be considered taxable income. So you can see that those, we talk about tax brackets, a lot of times single filers, it's like half of whatever the married filing jointly brackets are, but not the case with provisional income. Again, that's why planning becomes so critical. And that's what I wanted to touch on. So those are the ranges, those are the thresholds for provisional income. But when we're thinking about planning and advanced planning, that's why we think about, if you've gone through, been widowed or you've been divorced, if you've lost a spouse for some reason, then that pushes you into a single filing status. That's where these numbers really do become so important because your single thresholds are lower, but they're not meaningfully lower. So again, we talked about, the difference between 0% of your Social Security being taxable for single is less than $25,000, but it's less than $32,000 for married filing jointly.
Right.
Or if you're talking about being 85% of your benefit being taxable, it's over $34,000 for a single filer versus $44,000 for a married filing jointly couple. Okay. So again, it's one of those hidden taxes that you don't always think about or you don't always realize is out there that could come jump up and grab you. And this again, what we've talked about on a few different episodes where we talk about this, what I call the widow's penalty, where you might not change, your income might not change significantly if you lose a spouse, but this is one of those areas what actually could force you into either a higher tax bracket or force you to pay higher taxes, a higher tax rate on your Social Security benefits.
Okay.
Right. So a little bit of historical context on this provisional income. So up until 1983, so we think about Social Security first came into play in 1935. Up until 1983, Social Security was not taxable. That's actually when provisional income was added to the mix. So if that 1983 rings a bell by any chance at all, I've talked about it in a couple of different episodes. I've talked about it with increasing the retirement age. So that's the year that the retirement age for Social Security benefits was increased from 65 all the way to 67. It's also when the windfall elimination provision, the government pension offset were implemented. And we talked about that with the Social Security Fairness Act, which has now eliminated those two things.
Right.
But that was back in 1983. A lot of changes to the Social Security system back in 1983 when they were trying to, again, when we hear a lot about the Social Security system going bankrupt, they were worried about the exact same thing a little over 40 years ago. And these are some of the things they did to try to impact that.
Mm-hmm. Yep.
1993, something called the Omnibus Budget Reconciliation Act, if that doesn't give you a crazy head. This is when they added that second layer, which is the up to 85% of your benefit being taxable.
Okay.
Now, here's the big key, and this really impacts people today, is there has not been any inflation adjustment on those income thresholds since 1993. So when we think about the inflation we've seen over the last handful of years, you just think about the inflation we've seen over, that's a 30 plus year time period, right?
Right.
So the level of inflation we've seen over that time period and the thresholds for provisional income have not changed since then. So what does that mean? That means many, many more people are paying tax on their Social Security benefits because of this.
Okay.
All right. So a little bit of historical context. So now we start getting into, well, why does this even matter? Why does it, what could potentially happen if we don't understand the taxation rules on Social Security. And I want to walk through a little bit about what that Social Security tax torpedo actually means. And basically the definition of this is that for every extra dollar of income you might withdraw or earn from another source, whether that's you take a little bit extra out of your IRA, or maybe you work a little bit of overtime even, not only does that extra dollar of income get taxed, but it actually could cause more of your Social Security to become taxable, increasing what we would call your effective rate. And when you think about what percentage of your income are you actually paying in taxes, that's when we talk about the effective rate. So just a quick example, actually probably not a quick example, probably gonna take me a little bit of time to get through this, but I think it's important to understand. So I'm gonna use Sue as our example. Sue's a fictional person, but let's say Sue, she's retired and she's got $3,000 a month of Social Security benefits, $36,000 a year. And let's say on top of that, she's got about $40,000 in IRA distributions. So probably means she's got somewhere in the neighborhood of, $1 million in IRA assets if she could take $40,000 out. Maybe she has a little bit of interest mixed in. But if you just take those numbers, her provisional income in that scenario is about $58,000. So her IRA distributions are 40 plus half of her Social Security, which is 18,000. 40,000 plus 18 gives us $58,000. So then we say, okay, let's say she's got the standard, her house is paid off, so she just takes the standard deduction. She can't itemize. So here in 2025, that standard deduction is $15,000 for a single filer. Okay. Now, if we were to make the assumption she's over 65, it'd actually be a little bit more. Her deduction would be $17,000, but I'm going to make this math a little bit easier to get through. But if we think about that, then that puts Sue's taxable income right at about $50,000, which for a single filer, smack in the 22% tax bracket.
Okay.
So for 2022, the 22% tax bracket ranges from about, call it $48,000 up to about $103,000. So if her taxable income is $50,000, puts her towards in the lower range of that 22% tax bracket. And again, just a reminder is when I talk about being in the 22% tax bracket, that's what's called your marginal rate. So it's meaning that what tax rate is your very last dollar of income going to be taxed at? So that's your tax bracket, but it's also known as your marginal tax rate. So when people ask you, hey, what tax bracket are you in? And you say the 12% tax bracket or the 22, that's what we're talking about. So it's the very last dollar of income that you have. Where did it get taxed? Okay. So let's say just for conversation purposes, towards the end of the year, she decides she's going to take an extra $1,000 out of her IRA account. We hope that it's something fun. Maybe it's a concert or a trip or whatever it might be, but it could be a medical bill because she may not have a choice. She may just have to do it. So just that extra $1,000 from her IRA increases her taxable income from her IRA by that $1,000. But it also increases the amount of her Social Security benefit that is considered taxable by $850 because she's above that 85% provisional income threshold. So she takes $1,000 out, that becomes taxable. It increases the Social Security taxation by $850.
Okay.
So she only took an extra $1,000 out, but she's going to pay 22% tax on that $1,000. She's going to pay 22% on another $850 of her Social Security. So in effect, she's paying $407 on that extra $1,000 she took out of her IRA for an effective rate of about 41%.
Okay. What could she have done instead, Eric?
We're going to get to that.
All right. I want to jump ahead, man. I want to see happen.
But that's why we cut that tax torpedo. So basically, without even thinking about it, when again, she didn't have an option. She didn't. Right. Again, maybe it was something fun. Maybe it was something she had to do. But the bottom line is that extra $1,000 she took out of her IRA increased her taxable income not by $1,000, but by $1,850. Okay. So again, you end up paying more taxes than potentially is necessary without some of the advanced planning we're going to talk about here in just a little bit. And that's why the advanced planning matters so much, because the Social Security taxation doesn't happen in isolation. It's tied to your overall income. So you think about early planning, that's where we start looking at, how can we avoid some of these tax surprises? What can we do with required distributions? Protect your Social Security benefits from unnecessary taxation is the bottom line. And again, we think about solo retirees that have been widowed or divorced. That's where some of these numbers become that much more critical, and what you can do today, things you can do today in order to protect yourself down the road. So when we start thinking about strategies, to answer your question, So let's start thinking about what I talked about from the very beginning when I said, hey, here's the calculation for provisional income. I did not refer to Roth IRA distributions. So the first thing is, if you are still working, if you have earned income, you want to think about contributing to a Roth IRA account, because distributions from Roth IRAs are tax-free, assuming you meet all the guidelines, tax-free, and do not get included in your provisional income number.
Okay.
Right?
I like that.
That's number one. Number two is, of course, depending on your other income sources, you might be able to delay taking your Social Security benefits. So if you think about, hey, I need to continue working to pay the bills, I have the option, and if I'm over 62, I could also delay, I could also choose to start Social Security, but I might want to choose to delay it because of these tax implications.
Okay.
So you might say, hey, I can delay that, or maybe I have the IRA, if I've got $1 million in an IRA account, maybe I can draw enough income from that initially to, again, allow myself to delay your Social Security benefits.
Mm-hmm.
And again, delaying Social Security oftentimes, again, depending on the income situation, what your needs are, your cash flow situation, waiting, not only does that potentially give you less tax impact, but it also, of course, increases your benefit. So if you say, hey, I could take it at 62, but if I wait till 67, full retirement age, or I wait till 70, obviously that's also going to increase your benefit, not just reduce the potential tax implications.
Okay.
So then we also have withdrawal strategies. So withdrawal, what I would call withdrawal sequencing. Which accounts do I take money from first? Right. So if you're taking money from an IRA, traditional IRA, every dollar that comes out of there is going to be taxable at whatever tax bracket you're in. And as we saw earlier with the Social Security tax torpedo, that also could potentially increase how much of your Social Security gets taxed. So maybe I think about withdrawing from other sources. Maybe I do say, hey, maybe I can withdraw from a Roth IRA account. If I had an unexpected expense, maybe I could withdraw from that Roth account so I don't get pushed into a higher provisional income number.
Okay.
Right?
Yep.
Roth conversions. That's another potential option. So Roth conversions, depending on where you're at in your income scenario, you could convert some of those traditional IRA dollars to Roth dollars, right? So if you, again, depending on whether you've started Social Security or not, that could be an option so that you eventually, when you do have your Social Security turned on, again, gives you another source of income to withdraw from those Roth IRA dollars down the road. So doing Roth conversions, considering that as an option. Again, Roth withdrawals are tax-free and they don't count towards your provisional income number.
Okay. So I'm a little confused on the Roth conversions. How is that helping me avoid the extra taxation?
So let's talk about, for example, let's use, and I think it's almost always best to use some type of examples. Let's say, so I retire at 62.
Mm-hmm.
And my intention is to delay my Social Security benefits until 67.
Okay.
So I've got a 5-year window where I've got to have other income sources. Well, depending on what my income needs are, if I've got other retirement assets I can draw from, maybe I've got a brokerage account. And that's enough to cover my needs for some period of time. Well, if I've got IRA money that I'm not using and I'm in a low tax bracket, I might say, hey, well, if I haven't started Social Security benefits, I've got enough income coming from this other source, let me convert some of those pre-tax dollars that I haven't paid tax on, convert those to Roth IRA dollars so that now going forward, they're tax-free. Okay. So when that big expense comes up later down the road, after I have started Social Security, instead of saying, hey, well, the only place I can take it from is these pre-tax dollars, I can only take it from my IRA, using that extra $1,000 as an example and say, hey, well, instead of doing that, maybe I can withdraw from my Roth account.
Okay. So that is in preparation of the $1,000 need for
exactly.
Later. Gotcha.
And again, in many cases, what I talk to clients about a lot of times, I always say at some point you're going to have a big expense. Mm-hmm. You're going to call me and say, hey, I need $50,000. I need $100,000. I always say, again, I use the example before, I hope it's something. I hope you're buying an RV to travel across the country. I hope you're taking a cruise around the world. Whatever it is you're going to do, that's what I hope it is. I hope it's something fun, but it may not be. It may be a big healthcare expense. But at some point, you're going to call me and say, I need a big chunk of money. I need $50,000. I need $100,000. If the only place I have to take that from is a pre-tax account, an IRA account, or traditional IRA account, or a 401k, and I need $50,000, that means I'm probably going to have to withdraw 60, 65, maybe even 70,000 out to get $50,000 of spendable income.
Right.
And on top of that, it also could potentially impact how much of my Social Security I'm paying tax on. So that's why the advanced planning becomes so critical in saying, okay, if I have a window, if I'm going to be in a low tax bracket, should I be thinking about Roth conversion? Should I be contributing to my Roth IRA if I still have earned income to give myself flexibility? And that's really what it comes down to. You think about, I talk about when you allocate your investment assets, your retirement assets, think of it kind of like a table where you've got a three-legged table. You've got money that, almost everybody has that's where most people's assets are at, or pre-tax accounts, IRAs, 401k. So that's a third of your table. Your Roth IRA ideally would be that second leg of the table, right? Tax-free. And then your third is probably going to be some taxable account. Could be CDs, could be mutual funds, could be whatever it might be. But you want your three legs of the table, because if you're missing one of those legs, your table is probably not very sturdy, right?
Right.
So you always want to have a good place to take money. You want to have a smart place to take money, depending on what the circumstances are, whether it's a need, a wish, or it's something just unexpected that you just don't have any other sources of income. Having a good option to take those dollars from is critical when in terms of managing taxes and managing some of these hidden costs.
Okay.
Does that make a little more sense?
Yeah, and you really do nerd out on this stuff, don't you?
I
can
do.
see your eyes are all light up and
eyes go big and everything. Right?
He's like, tell me you don't understand. I want to explain it again.
Well, hopefully the explanation makes some sense, though. That's the key.
Absolutely.
So, and then the last thing I'll talk about is managing other income sources. So again, depending on your circumstances, I've also had clients, or we've run into situations where somebody's come to me and said, hey, I had to pay a chunk of taxes on my Social Security or my other income sources because I sold a house. People not thinking about capital gains on a residence or a second residence impacting you from a tax perspective on Social Security. So make sure you manage capital gains, because that is part of your provisional income. Even if it's just hey, I spent $10,000 on a stock and now it's worth $100,000. I want to sell it and diversify. Those gains are going to impact your Social Security benefits. Yeah. You want to be aware of that. Mm-hmm. Municipal bond interest, I've already talked about that one being quote unquote federally tax-free, but it could actually impact your Social Security taxation. So you want to be aware of that as well. Side income, again, if you've got a part-time job or if you're still working and receiving Social Security, making decisions on prioritizing, if I am receiving Social Security, or maybe I shouldn't be, maybe I should use some of the strategies we talked about a few episodes ago about maybe I should suspend my benefits. If I'm still working and I've got enough income, maybe I could suspend my benefits, or use some of the other strategies we talked about. Mm-hmm. So those are just some ideas in terms of, again, planning, some of the advanced planning options that are available. And then if we talk about some of the specific issues that, widows face, because a lot of our clients have gone through these circumstances, where if you just some advanced planning while you're still married can make a huge difference. Because again, we know, unfortunately, with the statistics being that women typically outlive men, if there's things you can be doing today and you are married, whether that's, again, managing Roth conversions or be preparing in advance, that can be really important. Again, optimizing your timing of withdrawals from your other accounts, Roth conversions, all these different things can really play an impactful role.
Okay. Just be prepared.
Be prepared and start in advance. Again, start looking at these things. You can't really, unfortunately, you can't do a whole lot about when you're right in the middle of it. It's some of these things you got to start doing in advance. Be aware of some of these strategies and say, okay, which of these apply to me today? Which of the things could I implement today in preparation for 5 years from now, 10 years from now? That's one of the things I always talk about with clients and people when we're having these conversations is the big advantage we have over the IRS is the IRS they only care about this year. From a planning perspective, we have the advantage of looking over not only this year, what can we be doing this year to minimize your lifetime tax liability, but what are the things we could be looking at over the next 5, 10, 15 years to protect you from some of these hidden costs. Uncle Sam only cares about the tax. We just had, tax returns were due April 15th. That's less than a month ago. Right. That's all Uncle Sam cares about.
He's like, I got the money.
That's right. We have the advantage of saying, hey, let's start looking this year now. That's right. We're right in the middle of that, as a matter of fact, of looking at what should we be doing in May to impact your tax situation this year and next year and 5 years from now and 10 years from now. Okay. So that becomes really important, is that advanced planning.
Got it.
So just a quick summary of some of the actions that you can take. Again, number one, just understand what your provisional income number is. If you're in the middle of this, know what your provisional income is today. Have an idea, do some projections. If you are going to start Social Security in the next, call it the next 5 years, have an idea of what you think your provisional income might be, but have an idea of what that number is and how it's calculated. Make sure that you coordinate your Social Security and your retirement withdrawals. That can be really important. Explore Roth strategies. We talked about either number one, if you're still working, you have earned income. You must have earned income to make contributions. To contribute to a Roth account, you have to have earned income. If you don't have earned income, but you're able to convert, that's the second option, either contribute or convert if it's applicable to you. So explore those Roth strategies. Work with an advisor who understands how to build tax efficient income plans. If you're not comfortable with it and you don't know really where to start, you know what your provisional income is, work with an advisor who can help you calculate that, do some projections, do some tax projections and say, okay, here's what you could look like. Are there things we could be doing today to give you a positive impact? The other thing I'm going to share is that utilize what we call our Social Security Quick Reference Guide. So if you go to our website, we'll actually include that in the links of the show notes. This is our 2025 Social Security Quick Reference Guide. It'll actually show you what these different provisional income amounts and thresholds are, and some of these other Social Security key facts and figures for this year that you can actually help you in your planning. So that's going to be something we're going to share in the summary of the episode. Hop on there, take a look at that. It's going to have everything you ever wanted to know about Social Security for the most part. But those are the 5 things I would suggest as far as, again, helping minimize or understand the taxation of Social Security. Wendy, any other thoughts, questions, clarifications you think that I might need to go back over?
No, I think you did a very good job. A+.
I appreciate it. Awesome. Well, that is it for today's episode of the Simply Retirement Podcast. I hope you gave this gave you a little bit clearer picture of how Social Security gets taxed, why early planning can make a huge difference. Until next time, please remember, retirement is not the end of the road. It is the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.